when you started doing LP investments and how that's shifted over time and why you go invest with other people.
I didn't get into real estate with the goal, but just I think like any other investor, I believed in the hard asset aspect of it. I believed in all the different ways that the real estate works. That's how I started. And then I kind of just slowly, okay, that's great. I'm going to go buy some rental properties. Then I bought another, and then a little bit bigger. And it just sort of snowballed to this, we sit here today. I think that the key thing for me, and you talk about investing in other people's deals and diversifying, who is the sponsor that you're betting on? Finding people you can trust in those, whether it's a different vertical, different geography. But I'm always thinking about who am I investing with more than what?
Hey there, and welcome to another episode. My name is Pascal Wagner, the host of the Grow Your Cashflow Podcast. If you're new here, we help accredited investors grow and diversify their monthly cash flow through low-risk private placements. To be clear, we're not financial advisors providing you advice on your specific financial situation, but our email list, our social content, and this podcast are all designed to help you learn how to find and vet passive income investment opportunities, so that someday when you're looking to grow your cash flow, that you'll consider working with us. And even if you never invest with us here, at the very least, we want to help accelerate your ability to gain financial freedom. So with that, let's dive in. Hey, welcome, Andrew. Welcome to the show.
Hey, thanks for having me.
Yeah, man. So could you give us a little bit of background on who you are and what you do?
Yeah, I'm Andrew Campbell. I'm a founder of Wildhorn Capital. We're based in Austin. I was born and raised here, and we've got about 4,000, a little over 4,000 multifamily units own and operate here in Central Texas, so kind of between Austin and San Antonio. Started in 2016, and prior to that, I was investing kind of on my own account and just grew a portfolio to the place that it made sense to consolidate, do larger deals, start looking at raising some outside capital, but kind of had our head down, focused in our backyard, and continue to have fun every day doing it. So we're still doing it.
I love it. And so one of the things what I wanted to do is, on this show, I love to bring out different fund managers and just get to know them and understand what are the nuances and differences between working with an operator like you versus the hundreds of others that exist out there. So I'm excited to dive in here. You mentioned that you're in Austin and San Antonio. I also know that you specialize in two very specific types of investments, which are build to rent and multifamily. Can you just talk a little bit about why you chose those two?
Yeah, and I probably goes back into my just personal background again. Sort of prior to Wildhorn, I had built a portfolio of rental, small duplexes, fourplexes, small apartment complexes. It's what I know. I think real estate is not, particularly multifamily, not super complicated. You put some leverage on it, don't get over levered, but you have a loan. You have renters that pay the mortgage. You're paying down the loan. Things are amortizing, appreciating. So it's always made sense and felt comfortable to me. And so I think that's why we've stayed in sort of residential housing. So, multifamily, build to rent is it's a very new acronym, BTR, B2R. A lot of people are talking about it, but it's residential housing. At the end of the day, it's horizontal apartments, kind of renting homes instead of 1,500 square foot home instead of an 800 foot apartment. But it's always kind of been the focus. And I think maybe the differentiator that let's say we've got, or sort of maybe the constraints we put on ourselves, is geography. So I'm born and raised in Austin and feel like lucky, got born right age, right time in a city that's exploding in growth, and really think that that's been a key part of both our success, but sort of our responsibility to investors, that not looking at growing nationally into a bunch of new markets that you're not super familiar with, but focused on our backyard and the intimate knowledge we've got in where you want to be and kind of where you don't want to be, and then leveraging relationships to find deals that do make sense. And it's just staying home local and to focus on residential housing. It's meant B2R and multifamily are kind of the two main areas that we focus on.
Okay, helpful to have the background. You mentioned this term horizontal housing. Can you just briefly talk about that?
So, build to rent, you'll hear the acronym BTR, B2R, BFR, build for rent, SFR, single family for rent, all describing the same basic concept, which is a community purpose built to have homes that you're renting to people. And so from an operations standpoint, what we do as an operator, it's not very different, whether it's a 6-story apartment building, traditional sort of multifamily, or a 3-story garden, walk-up apartment complex versus a 156 unit B2R community. People call those horizontal apartments because they're homes and they stretch more horizontally rather than they're not. The big appeal to them from a renter standpoint, no one lives above you. You've got an attached garage. You're signing the same type of lease. So it looks and feels and operates just like an apartment, but you'll hear them called horizontal apartment is generally an easy way to describe the B2R concept.
How'd you get into doing both? Or why do both strategically? Because I imagine there's some overhead and, like managing an apartment building is different than a horizontal community.
There are some slight nuances for sure, and you look at there's a lot more rooftops on a horizontal BTR deal than there is a traditional garden deal. But from an operations standpoint, the staffing, the leasing model, the marketing, all of that is very similar. The demographics may be slightly different, but not more so than, say, a brand new Class A apartment, which we have several of, versus a 1980s, Class B minus apartment. There's a different clientele and different demographics. So it's not a big jump, and I don't necessarily even think of it as a very different food group. Again, BTR, a new concept, I think, and something that has attracted a lot of attention from a capital standpoint in the institutional, capital world. And I think kind of two different trends that are happening that make it grow. Number one is just the sort of millennial generation aging out of wanting to live in an apartment complex. And when you look at the average size of an apartment these days is about 750 feet, maybe 800 square feet. They're mostly 1 bedroom with some 2-bedroom units. That's just not that much space. And as people are coupling up, having kids, wanting more space, wanting a garage, their own yard, this product, this is in essence, it's a 12 to 1,500 square foot home. No one lives above you. That makes sense for people in their life stage. It also makes sense kind of on the other end of the spectrum, more of an empty nester, thinking, wanting to downsize, not wanting the maintenance, the upkeep, take care of your yard, take care of just, all the things that come with home ownership. Makes sense for that demographic as well. And then just financially, you look at sort of the challenge of affording a home, take off the interest rates and the rise in rates in the last year, but it's been harder and harder to afford a home, even prior to that, even now more so. And that's one of the things those are the reasons that BTR has become a popular product type.
So I try to go at this from the educational perspective of, okay, there are so many funds out there. What is the thing that makes your fund unique, or maybe let's even lower the educational barrier of how your fund works? Like, let's talk about who's the customer that you're trying to attract. Or is it someone who's trying to grow their equity, or is it someone who is, looking for consistent cash flow? Like, obviously you're doing multifamily. Are you doing value adds where you have, a period of time when someone invests so that they don't get cash flow for a year or two, and then they should expect to see kind of monthly or quarterly cash flow from that? How you've structured your investment and the way that you service your investors, and why you've chosen to do it that way. Okay.
So a lot to go through and unpack there, all super relevant and good conversation. You said something about the people you're trying to attract or advertise to. And I think one thing, and maybe it's just nuance, maybe it's my marketing and advertising background. Actually, I have an advertising degree, undergrad, but we've never gone out and said, hey, we want to be advertising to people. We've never run a paid ad, don't do search advert. Like, it's we are doing deals that we like and believe in investing in. And again, my background prior to Wildhorn, like I love real estate and I like investing in it. We're doing deals that are interesting. And then I think we view it as, hey, it's an opportunity to invest if you like the deal. So it's not a sales tactic or a marketing platform. Sure, you want to be easy to be found, but I think that's one, maybe it's a subtle nuance, but we're doing deals because we believe in them. We've got conviction about them. And then if you if you agree with that thesis, we'd love to have you in that deal. So that's maybe one place to start. Second thing you said, kind of our fund versus another fund. So we do everything.
Let's dive into that real quick. So I think what I'm trying to get into here is I think there are different types of investors. There are the investors who are 60 and who are retiring and they don't want to take a lot of risk and they are looking for consistent monthly passive income so they can peace out and, not worry about things for the rest of their life. And then there are the demographic of maybe younger individuals, either they work W-2s or they are, senior executives at companies, or they may even run their own business. And they have, varying from a limited amount of cash flow that they stock away each month, maybe as a W-2 employee, to maybe more of a business owner that, is maybe getting $10, $20, $50, $100,000 a month, and they're looking to place that capital. And so those two people are very different types of people. And so when I'm asking you, I'd love to dive in, who are you targeting? Are you targeting or maybe I would say, you're saying you're not targeting anyone, but let's talk about of the demographic of the investors that you have in your fund. I mean, I think you have over 400 million or something. You have a solid investor base. Who are those people? Why are they investing with you?
Sure. Well, so I love it. I think they're very different, as you pointed out. I think what I found to be really interesting, the demographics certainly can play a part in that. But I think more so, it's just kind of the way people are wired. Some people are risk on and they're always, looking for opportunistic returns. And we always say, hey, everything's risk adjusted. So a 20 IRR is a heck of a lot more risky than a 13 IRR, no matter what the pro forma say. You got to know that. And some people risk on and some people are risk off. And I think it's as much about their mindset, their demographic and sort of life stage has some impact to that. But I think it's more just the unique story. And that's one of the things I love about this space and getting connected with people is, literally on a first call, getting to know somebody, you're probably learning things about them that their best friends may not know. Hey, this is how much, my net worth is, or kind of what my investing goals are, I'm trying to get to retire in 5 years or get my kids through school, or what really personal sort of intimate details. And I think it's great. It's fun to kind of get to know people on that sort of a level and understand what their goals are. We do deals deal by deal. So we don't have a fund structure. We've done, and we have value add deals that are 3 to 5 year, that's typically more get in quicker, renovate units and get out. And we've been fortunate to have exited a bunch of those deals. We've got longer term, bought brand new Class A projects that are going to be 10-year holds that are meant to be cash flow oriented. And you're not looking at an IRR as much because the appreciation is you're looking at, hey, I've got a fixed interest rate, almost like a REIT type structure. So we've taken the attitude, it's really more finding an asset and a business plan that we have conviction about. Could be long-term, more cash flow oriented. It could be a shorter value add or an opportunistic redevelopment type opportunity or something in between. But if we find something and we have conviction about it and a real strong point of view, we believe in it, then, we're going to go forward with it. And then again, kind of present that opportunity, recognizing that, hey, if it's a core plus long-term opportunity, you're not, the people that love risk won't do it. It's kind of funny because on the other end of the spectrum, that cash flow oriented, maybe, older, empty nester is concerned, hey, a 10-year, I don't want to do something for 10 years. I don't know. I'm 73 years old. 10 years from I'm 83. I want a shorter term duration. So again, it's unique to people, but kind of taking the approach of once we find something that we believe in, take it to the market, and there are investors that have, even the same investor, different points in time, have different operating mentalities.
Totally. Yeah, no. Okay. No, that was awesome. Thank you. Thank you for diving in there. Keep going with like what makes you unique. You were going through the steps.
So I think that's a part of it, right? That we're looking for interesting deals. It's not just a one size fits all, or we're only looking for this one specific thing. I think that the constraints that we've put on, again, it's going to be Central Texas based. I believe that leveraging the relationships, having a really intimate knowledge of, hey, you're in the right area of town, but you know what? Are you on the right intersection? Are you on the right side? The northwest corner is great. The southeast is not great. Like, you need to know those things, and just have always felt much easier to know those because we're here. We grew up here. We know it. And I think the responsibility of raising capital, of being a steward of somebody's investment, that I'm never going to know that and feel as comfortable in a market that's not Central Texas. I'm never going to know pick a city as well as I know this, because I've been here for 43 years. And so I think that's, I don't know if it's differentiated or not, but it's something that I think we do take seriously. And the responsibility of, raising money. I mean, you mentioned, I don't know what our portfolio is worth, $900 million. That's a lot of money. That's a big responsibility. I don't want to be flipping about, we're riding the wave in the Carolinas. I think the Carolinas have been on fire and they're doing great. I've visited them a few times, but I'm never going to know it as well as I know Austin. So I'm going to leave that for somebody that grew up there or is doing, much bigger infrastructure and has people based there.
Yeah. So before the show, we through the bio that I collected from you, I found that you were also an LP investor, right? You've done several different LP deals. I think even over 20. So in this scenario, what I'm trying to really educate my audience about is how do other investors think about investing? And you obviously have your own active portfolio with Wildhorn Capital, but then you also invest in other people's deals. So you mentioned this concept of, I don't know, Austin really well, but you wouldn't know North Carolina as well. And so when you started doing LP investments and how that's shifted over time and why you go invest with other people, because I want to show that that a lot of fund operators are also diversifying more than in their own thing.
Yeah. So, I was an LP investor long before I was an active, GP sponsor. I didn't get into real estate with the goal of, I want to go build a big portfolio and have all these assets and raise all this money. It was it's an investment that I get. Again, it makes sense to me. I'll just be a passive investor, look for early ways to not just to retire early, but it's a good return. It's something that I don't need to I don't have to do. I was, doing a lot of different things, working at the time, but just, I think like any other investor, I believed in the hard asset aspect of it. I believed in all the different ways that the real estate works, and not a huge believer in just the stock market and just sort of putting it into an index fund and hoping that things go up. Like I loved the hard asset aspect. So that's how I started. And then I kind of just slowly, okay, that's great. I'm going to go buy some rental properties and then I bought another and then a little bit bigger. And it just sort of snowballed to this, we sit here today. It was never the intent and the goal. I think that the key thing for me, and you talk about investing in other people's deals and diversifying. And I mean, it's about betting on the jockey, and I think that's what, anytime I'm looking at a deal from a passive standpoint, and certainly, we've got folks that come into our deals that want to, look up our skirt and our background and ask tough questions. Like, that's 100%. You should. I mean, like, the market's important. The business plan is important, but who is the sponsor that you're betting on, and how do they respond in times of crisis? What decisions do they make? Are they really thinking with your best interest, or are they out, is the deal structured where there's good alignment? And I mean, certainly I've had some deals where gotten burned, learned some lessons about getting, sucked into a really sexy looking business plan, high risk deal. And you realize that, I bet on the wrong jockey. And that's, I think, the reason I continue to sort of invest in other deals and put money in funds of other folks is like, I'm not everywhere. I recognize geographic diversity is valuable. But I'm not the expert there. So, finding people you can trust in those, whether it's a different vertical, different geography. But I'm always thinking about who am I investing with more than what.
That's something that I'm very much thinking about right now, active versus passive. And I probably make half of my income from passive investments, and I make half of my income from my active real estate portfolio. It's interesting that you went and had all these passive investments and then went active, whereas I'm in this position where I'm the opposite. I had active investments, and now I've been diversifying into passive, and I'm realizing how much mind space it frees up. And I'm giving up some slight returns for being more passive, but the time I get back is so much more valuable. And I'm trying to continue to make that transition. Talk to me about why you went the other way.
It is kind of counter thought. I think you get into it and you're like, oh, I'm going to sit on the beach and I'm going to just have all this time. And that's the dream. Just got mailbox money of whatever your target number is every month that you can, hey, I don't have to go do anything. And I think the more assets that I bought and the further we got along the journey, I just realized, like, man, I just fundamentally love the deal. I love the fact that I can see it, that I can, you can have a vision if it's a value add deal or the creativity involved in a development deal, to look at a old derelict building or a patch of ground and seeing some of these like really big redevelopment plays that have happened in different cities. And you're like, man, the creativity and just the conviction of somebody to go make that kind of play it's just always been of interest. And I think doing the deal, I realized like I would be bored to tears. I've got too much ADD to just sit and do nothing. And the active, being a participant in it, is super exciting. And then at the same point, truly the relationships, having the conversations, getting to know about you and your family and your goals, like that is you get to connect with people at a more intimate level than you do just with your kids' parents who are your friends and you have sort of surface level relationships with. I think that connection piece and the creativity, I'm having a lot of fun, and realized I'd be bored sitting around doing that, playing golf, going to the beach all the time. Like it's fun to be the art of the deal, putting something together, finding it. And it's a lot of fun.
Yeah, I resonate. I'm trying to play it at a slightly higher level of just focusing on doing passive deals versus active deals. But that's why we invest in funds like you. So I get that. How has inflation and what's happening in the economy affected how you look at buying, right? So you've been doing this, I think, almost close to a decade. And yeah, I misquoted you earlier, but yeah, 800 million assets under management. Like, I imagine that the way that you look at buying assets and the environment and how everything is changing is different today than it was. I'd love to understand how that's changed, and then what's your prediction for what's going to happen over the next couple of years?
Well, certainly it's been a very interesting year. Real estate sort of uniquely has felt the pain of the hike in interest rates and sort of what that's done to your ability to get any amount of leverage on a deal. The way that you underwrite deals has looked very different. And because of that, we've not been very active this year. We've closed on 2 new projects this year. Both of them are new development oriented. So we have a builder developer who's our partner. And we are kind of a build a core strategy where we're going to build it, lease it up, and then operate it. So it's, again, kind of 5 to 7 year type horizon, not meant to be a build it and sell it. Those have made a little bit more sense where, because you're not trying to go sell it immediately, and you want some of the longer term tangible aspects of real estate with it is a great inflation hedge. You still can get some positive leverage. So, but on the acquisitions front, we've not done deals because it just hasn't made a lot of sense, and that's something I think you always got to be conscious of. And one of the reasons as a company we've stayed very lean, not having to have a big overhead where you're trying to do deals because you need to generate a fee, because you need to meet payroll, and you need some base revenue to keep your company going. We've really worked hard to avoid that. We have a 6-person company, so we can weather storms like this, and frankly, just kind of be patient, manage the deals, the portfolio that we've got, and we'll look for and wait for opportunities on the acquisitions front that either come from a distressed deal that has fallen out or gone back to the bank, or wait for the environment to calm down a little bit and acquisitions make sense again. But I think you got to be patient and it's just ride the wave a little bit.
When you say you need to be patient, like, what are you waiting for? Are you waiting for prices to come down? Do you think they're too high? Give me an idea of what that means.
Yeah, I mean, so we're not trying to time the market, and I think one of the things that we always have believed and continue to believe, we're long-term believers in Austin, in sort of the Central Texas growth story, and being residential housing focused. It's about population growth and job growth. Like, those are sort of the two metrics that we obsess over and are always tracking. And we've been lucky. We've been one of the most prolific creator of jobs in the country. Austin has for most of the last decade. I think even this year we're going to finish again at or near the top of that list. So it's not about timing it in a 2 or 3 year window. It's hey, is this an investment, an asset, in a location that we feel good about if we go long? And long might be 5 years, it might be 10 years. It could be more than that. But if you've got the right sort of tailwinds from a big macro environmental standpoint, that's one of the benefits, I think, of real estate. If you've got a loan that's amortizing, it is an inflation hedge. You're buying in today's dollars. You're selling it in the future in tomorrow's dollars. Like, it has all those benefits. There's tax benefits of it. So being patient means sticking to your underwriting fundamentals. Looking at, hey, interest rates are a lot higher than they were. That factors into the way you look at deals and sort of what makes sense, but not bending on your underwriting criteria just to go like, hey, this is a deal we think is going to be great. And you don't really truly believe that. I think that's, to me, what being patient is.
Yeah. Do you have like a rough criteria or a buy box you're able to share? I'm starting to teach this idea of having a buy box as an investor. You need to have, in my buy box, when I buy single family homes, I buy them that have at least 2,000 square feet, that are 1965 or older, or newer, or, what. And that really helps me filter out what properties are great fits. You've mentioned things like having a great location, the northwest or whatever is better than the southeast. What goes in that buy box? And I'd love to maybe understand the story of how you got there. Because that's what makes a fund, right? Like, that's what makes a fund interesting.
Yeah. So our buy box, I mean, in the hard and fast sort of criteria, it's Central Texas, right? So you're never going to see something that's Florida or Atlanta or Houston even. I mean, we are a Central Texas focused group. So that's number one. And then I think within that, there are different criteria. If we're looking at a value add deal, that's going to be something 80s to early 2000s, maybe even mid 2000s. I'll tell you, in San Antonio, our buy box doesn't include 1980s product, 8-foot ceiling. Like we've just seen, there's a literal sort of hard cap on where you can push those rents to. So we think, 9-foot ceiling is really important. That typically means 2000, year 2000 vintage. There might be some late 90s stuff, but nothing was really built in the early 90s, mid 90s, as Texas was coming out of the savings and loan crisis. So we do have criteria, but it's going to be a little bit more tailored to like, what's the business plan? If it's a newer construction, a wrap deal that we're looking at, the location of both today, but like what the future of that location looks like is really, really important. Within that, we're looking at schools, what do the schools look like? If you look at sort of our portfolio and you sort of track the dots across the map, more often than not, there's going to be a story about the schools that feeds to. We own a deal, was completed in 2019, and it is the only apartment building zoned for that can ever be built that will go to a specific elementary school, which is a very highly rated, competitive school that people love send their kids to. The only apartment that can ever go to that, just based on the zoning. That's a very compelling. That was our point of conviction about that. It's a great area. My brother lives in the neighborhood that surrounds it, but it's like, okay, I get it. There can't be more supply. Sure, there can be more supply in Southwest Austin. There can be more stuff that comes on, but within this sort of micro pocket, that's it. Will be the only deal. If you want to go to that school, which people do, you value that, this is the apartment. It's that type of conviction and story point that we have kind of over and over and over. So it's more about the story of the deal, which again, maybe why I love the active participation in the deals, because there's a story to them, less than like, hey, here's our check the box. If it checks these 4 boxes, we're in. It's never that simple. But schools is typically a big example of something we're going to pay a ton of attention to. When again, you're talking housing and people with their families and their kids, like that matters. So pay a lot of attention to it.
I love that. That it adds so much more color into how you pick deals, which is, I think, ultimately like how someone decides they want to invest with you. Like, do they like hearing that insight? It adds a trust and expertise component. So I'm glad you dove into that. Where my next question would be, what's something that you've had conviction about and it turned out to not be the case? Because I'm imagining this is where all the learnings happen, right? And it just increases your conviction and your expertise in doing deals moving forward. Can you walk us through a story maybe of one of those examples?
Yeah, a couple that come to mind, and luckily, like locationally, we've not missed. Right? Again, I think helps local, like that part we always feel pretty good about. I think part of the reason that I mentioned San Antonio, it's got to be a pretty unique story for us to jump into, kind of an 80s built 8-foot ceiling product. We've seen there be a cap on those rents, but we've also gone through some pain with some just older plumbing, big leaks that happen, things you didn't have accounted for in your CapEx plan. That we had a $300,000 plumbing leak that was one of our main lines that no one knew about it because it hadn't impacted the, people's showers were still working and all that. But we get these water bills and they're just massive. I'm like, okay, where's this? This is wrong. There's no possible way we're using this much water. Well, it was going right into a storm drain because we were like, come show me where the river is that should be flooding through the property if we're using this much water. And like, you don't have that sort of stuff built into your business plan. I mean, sure, you've got some contingencies but going through a couple of those on some of these older buildings where, it doesn't matter how much contingency, you don't have that much. And luckily, being able to work out of that and still, we exited that deal and it was a great win for investors. We actually beat our pro forma just barely, but we did. I think that's part of the reason we're always going to be a little bit more cautious on older product. And I think from a due diligence standpoint, we'll do double the amount of due diligence on the plumbing and on some of the older components of, hey, what type of pipes are they? What condition are they in? We're going to put a camera down at every single line, understand. A lot of times we've gotten the plumbing systems mapped coming out of that to where we know there's a certain type. If you're on a looped boiler system, okay, here's a boiler. Well, what buildings does that serve and how is it going through? They're like, we need to know those things going in so we can appropriately underwrite a budget. If what state is the system in and what does it look like if we got to go in and fix it? Those are examples of things you learn after, you wake up to a $80-some thousand water bill that goes on for 4 and 5 months till anybody can figure out what the heck's going on.
Yeah, I actually have. I just had one of those happen to my portfolio of 12 properties. Same thing. Water bill is like 10x what it should be. So I think it highlights a point that I want to emphasize, which is, I think these learnings are only valuable if you continue playing the game. So I think there's this, I kind of have this pet peeve or just this, it's just a lack of knowledge or awareness, but it's, a lot of people want to get into investing in certain deals. Maybe it's buying residential real estate or buying a multifamily property, but it's, the learning curve is so high that to just do one or two deals and it not be your profession is almost, you're cutting yourself short. And I think the example that you gave is a perfect indicator of that, right? Like, so now moving forward on every deal, you've added into your SOP, your standard operating procedure, and you're now avoiding that and being able to deliver consistently higher returns moving forward. So, what's your take on that? Do you agree? Active,
There's no question you're going to continue to stack experiences and learnings and be a more aware, more knowledgeable investor. You're just savvier. The more time you do deals, you run into things. And so I do think that's right. I am more aware of things now than I was the first time we raised money. I was more aware of things just based on my own portfolio of stuff before we got to that point. So I think that's true. It's interesting because the life cycle of an investor, and you're talking about, I kind of, swimming upstream, going from passive to active. If the goal is to transition to more passive, at some point you do want to stop, being in the weeds and you want to sort of check out. And so you might only end up doing a couple of deals and you've met your goals or your objectives, or you get shiny object syndrome, you sort of move on. I think the challenge with real estate investing and real estate for an investor is recognizing, certainly, go back to the last 10 years and kind of the way that returns were coming in and cap rates were compressing and, people were churning out these huge returns. That's more of an aberration than what is likely going to continue. So it's a business that has always been, I think, sort of get rich slow and sort of wealth preservation. There is a hard asset. It's not some fictitious stock in a company that may or may not exist or do well. And like, I can go see the building that I own, or have invested in. I can see the financials. It's not that difficult, but it's also not hey, you're not going to hit a 5x. Heck, you're not going to hit a 3x very often unless you've just caught exactly the right moment in time and got really, really lucky. So being and staying patient, recognizing, understanding why you are investing in real estate and sort of where that fits within your portfolio, because it could and should be a part of it. It's sure probably not the whole thing, but that's probably the part where you gotta stay patient. It's get rich slow and asset preservation as much as wealth creation and hitting big multiples.
So I'm with you. The next 10 years are going to be definitely different than they have been the last 10 years. Even if you just look, the last time mortgage rates were this high was I'm looking at a graph right now, back in 2001, or even just slightly before that. So, like, obviously the last 2 decades, interest rates are not where they are then. And I have two questions, one on the class of product that you have and the other on your prediction moving forward. I think moving forward, obviously the next decade is going to be different. And, I think there's one of three scenarios, either we think interest rates are going to go lower again. And so maybe a good time to be investing in these types of assets. Either it's staying the same, or if we expect interest rates to go up, I would argue it would be a terrible idea to be investing in these types of assets. If we have anything like we did back in the 90s or even the 80s, if we have interest rates above 10%, that would be catastrophic to any kind of investor in these assets. Do you agree? Where do you think it's going, and why?
I don't know where it's going. I think would love to. Everybody wants to make a prediction. I think you're biased if you're in the real estate space. You'd love for it to be lower, right? It's because it's been great times the last 2 decades. To your point, free, cheap, easy money makes everything look good. I think one of the things about back to sort of residential housing, people have to live somewhere. And so interest rates are what they are. If they go to 10%, pricing will have to adjust and what people are willing to buy and sell. Like it may be painful for the people that own stuff now. Are we going to hit home runs on our portfolio if they hit 10%? No, but you got to continue to look at, okay, where are people going to live? And if interest rates are at 10%, how much more unattainable is the average price of a home? And the people that are locked in at, a 3%, 4%, 5%, hell, even the people that are locking in now at 7%, if they go to 10, are be feeling pretty good and they're not going to be moving. You still got to live somewhere. So things will readjust. And I think it goes back to if interest rates are at 10, as far as what that means for the macro economy, I'm not smart enough to know all of what that means, but like, what else are you going to be investing in? Again, you go back to sort of the fundamentals. At least what I love and believe in is like I got tax benefits from real estate. You got the depreciation. It's a hedge on appreciation. Rents are going to, it's going to stay full. And I can't say that about office. I first thing I do every morning is sort of hit my knees and thank God we're not in the office space, because there's just so much uncertainty and conversation. What does that look like? Are companies coming back? Now I see headlines where CEOs can't wait for 2024. They're going to be jamming their people back to the office full time as sort of some of the power drifts back to employers. Is that going to happen? I don't know. Will people continue to work from home? Do you need less space? There's a lot of uncertainty. The way that residential housing looks could change. You do more work from home. You need to create more office spaces, co-working within an apartment building. There's a lot of solves for that. But I do know that people need somewhere to live. And I think that's something that we look at, again, big picture macro, not a 2-year horizon or a 5-year horizon, but look at 10-year horizon or longer. Where do the jobs go? Where are the people going and moving? And they have been moving to Texas and to Central Texas, and it looks like they will continue to move there. And so I think pay attention to that a ton, and not worried about interest rates, but I can't control them. And I do think if they hit 10%, you're going to have more renters because no one wants to buy a home or can afford to buy a home. I may not have more office workers. I may not have. I don't know what retail looks like if that continues to shift and ebb and flow. And but get back to sort of residential housing feels pretty stable.
The other piece that you covered earlier is that you have different products. So you have Class A and maybe something that's not Class A. Am I following? And yeah. For everyone that's in the audience that doesn't know, there's different grades or quality might not even be the right way to describe it, but classes of real estate where there's luxury Class A. Think of these as like your brand spanking new apartment buildings that have that you're paying super high rents on, and then there's B and C and D, and D might be in the ghetto, and it might be a rundown type of building. How would you describe the differences between those for our audience? And then I'll hop into my question.
Yeah, I think that's right. It's the nicest, newest properties in town. The downtown high-rise are A, higher rents, higher demographic, higher income. It's a little bit subjective on what makes an A versus a B versus a C versus a D. It's kind of funny. You hardly ever hear anybody talk about, I'm investing in a D class deal. And we've always kind of said, hey, I don't want to be, we've never been the group trying to buy a C class deal and turn it into a B. I think that in itself is difficult. And there's a lot of challenge in making a big transition of who your demographic is and so what that looks like. But you nailed it. I think it's pretty subjective what the difference is, where those lines are, but at a high level, agree with the way you laid it out.
So there, I couldn't hear you for the last little minute. It cut out, but I'm explaining. I assume that you were just talking about the different Class A, B, and C. What I'd love to get into now is, okay, so given Class A, B, and C, I, as an investor, have been thinking about, especially over the next 5 years, when we think about recessions and we think about everything that's happening in the economy and everything being unstable, my perspective is to invest in things that are on the lower side of the classes. So, Class C, Class B, whatever you want to call them, anything that's not luxury Class A. for the reason being that in times of economic crisis, people aren't going to be splurging and going towards these luxury Class A buildings. People are tightening their wallets. And so that'll create more demand at the bottom of the food chain for workforce housing and things like that. So that's one perspective. You just mentioned that you are looking at deals or have deals that are Class A that are structured maybe as more longer term deals. How would you, I guess, you clearly have a different perspective about the market in Class A versus, Class C, given the next couple of years. What would be your take on why?
Well, I think you're right. First off, that if you're at the very top of the market and there's a slowdown, a pullback, a recession, whatever you want to call it, people are wanting to pare down. I need to spend less in rent, and so I'm no longer willing or wanting to pay $3,500 a month for my downtown building. I'll move and I'll pay $2,500 and save $1,000 a month. That person's still kind of in an A-class apartment in my mind. I mean, 25, particularly in Austin, if you've left downtown, and that the A-class stuff we own tends to be more in that realm. It's sort of wrap built, nice product, but a little bit sort of first tier outside of downtown locations. I think there's a line at which, and I've always felt this way, you want your incomes on, call it your B- asset, to be able to sustain a small blip. Someone losing their job, like the service worker economy when COVID happened, right? Like instantly food servers, everybody, like they were out of a job. They weren't working. Like if you were a day laborer, I mean, if your income is sub $50,000, like you're much more paycheck to paycheck, you have no safety net. There's a lot of risk there. And if that's your tenant base. So I think being in the sweet spot to me has been that kind of Class B plus A- area, that not top of the market rent where you could see some pullback, but a stable enough demographic and sort of income base that you have a bit of a nest egg. You've got some savings. You've got the ability to, be creative if you need to be to consult, to, put something together. That if you're true hand and mouth, like there's a lot of risk on the downside as well too. So that's kind of been my thought on demographics.
That's fascinating. Definitely not a perspective I've heard before, but it makes sense. It definitely makes sense. If I think about the groups that I'm in and the people that I know and the type of properties I have, I work all in affordable housing, and you're so right. Like if something goes sideways, that tenant has issues, and it's not pretty. It's not also easy as a landlord. So I get that. Fascinating. Okay. How can people learn more about you and what you do and get on your list? We're try to be pretty easy to find. Our company's Wildhorn Capital. The website, it's wildhorncap.com, and we try to have some good kind of educational content there. You can certainly join our newsletter list. You can always email me. I'm Andrew at Wildhorn Cap, and happy to have a conversation, talk about more of this, kind of what we've seen, what we're up to. But website and email is typically the easiest. Thank you, Andrew. This was awesome.
Yeah, thank you for having me.
All right, now I have some final thoughts for our listeners. There are over 350 of you who are already on our email list. But if you aren't already, if you'd like access to our database of private investment opportunities that we see every week and get a first look at the opportunities that we put together here at Grow Your Cashflow, you can join our investment club at growyourcashflow.io. Now, if you found this particular episode helpful, don't forget to share it with that friend that might benefit. And lastly, if you have any questions or suggestions or just love the particular show, reach out to me on Twitter at Pascal Wagner #1. Thanks, guys, and I will see you on the next show.